How can investors achieve broad market diversification and simple access to various assets without significant capital? In this video you will learn the fundamental structure of exchange-traded funds, how ETFs are traded on exchanges, the diversification benefits inherent in ETF portfolios, various types of ETFs available, and key factors for selecting the right ETF. An exchange-traded fund, or ETF, functions as an investment vehicle that holds assets such as stocks, bonds, or commodities. Unlike traditional mutual funds, ETFs are traded on stock exchanges throughout the day, similar to individual company shares. This structure allows for real-time price fluctuations determined by market supply and demand. The operational framework of an ETF involves a creation and redemption mechanism. Authorized participants, typically large financial institutions, create new ETF shares by depositing a basket of underlying securities with the fund provider. Conversely, they can redeem ETF shares for the underlying assets, maintaining the ETF's market price close to its net asset value, or NAV. A primary advantage of ETFs is their inherent diversification. Many ETFs are designed to track specific market indices, such as the S&P 500. By investing in a single ETF that mirrors such an index, an investor gains exposure to hundreds or thousands of underlying securities, mitigating the specific risk associated with individual stock selection. ETFs offer remarkable simplicity for investors. Their exchange-traded nature means they can be bought and sold through a brokerage account with the same ease as common stocks. This accessibility reduces barriers to entry for diversified investing, allowing participation with relatively small capital outlays. The landscape of ETFs is diverse, encompassing various asset classes and investment strategies. Equity ETFs track stock market indices, sectors, or specific geographies. Bond ETFs provide exposure to fixed income securities. Commodity ETFs invest in physical commodities or commodity futures. Thematic ETFs focus on specific trends, like renewable energy or artificial intelligence. Significant advantages of ETFs include their liquidity, often allowing for rapid execution of trades at known prices. Their cost efficiency is another key benefit, typically featuring lower expense ratios compared to actively managed mutual funds. Furthermore, transparency is high, as most ETFs disclose their holdings daily. However, ETFs are not without their complexities and potential drawbacks. While tracking error is generally low for broad market ETFs, it can be higher for more specialized or thinly traded funds. Liquidity risk can become a factor for niche ETFs, potentially leading to wider bid-ask spreads and increased trading costs during periods of market stress. Understanding the costs associated with ETFs is crucial for long-term returns. The expense ratio, expressed as a percentage, represents the annual fee charged by the fund provider for management and operational costs. Investors also incur brokerage commissions when buying or selling ETF shares, although many platforms now offer commission-free ETF trading. Selecting an appropriate ETF requires careful consideration of several factors. Prospective investors should evaluate the expense ratio to minimize ongoing costs. Examining the ETF's tracking error ensures the fund accurately replicates its underlying index. The liquidity of the ETF, measured by average daily trading volume, affects ease of entry and exit. Consider an example. An investor seeking broad market exposure might choose an ETF tracking a global equity index. This single investment provides diversification across numerous companies and countries, reducing the impact of poor performance from any one region or corporation. The investor benefits from passive management and lower costs. Comparing ETFs with traditional mutual funds reveals distinct differences. Mutual funds are typically priced once daily after market close, based on their NAV. ETFs, conversely, trade continuously throughout the day, offering greater flexibility for investors to react to market movements. Mutual funds may also have higher management fees and sales loads. The distinction between ETFs and individual stocks is also critical. While an individual stock offers concentrated exposure to a single company's performance, an ETF provides diversified exposure to an entire market segment, sector, or asset class. This diversification inherently reduces the idiosyncratic risk associated with holding individual securities. ETFs offer investors an accessible and efficient pathway to diversified portfolios. Their structure facilitates ease of trading, cost-effectiveness, and transparency, making them suitable tools for various investment objectives.